Most early-stage investments involve more than one round of funding, and anti-dilution is a term that seeks to protect investors from the changes that can occur between the rounds of investment. Most early-stage companies require 4 to 5 rounds of funding before they reach an exit, and therefore the earliest round investors will be keen on preserving the protections they negotiated as additional funds are raised. There are 2 forms of anti-dilution: non-price-based or structural anti-dilution, and price-based anti-dilution. Both forms are designed to prevent dilution of early round investors and the potential erosion of their returns as future funding is raised. The most basic form of anti-dilution protection is often referred to as structural anti-dilution, and also is called non-price-based anti-dilution. This protects against the effects of stock dividends, stock splits, reverse splits, and other recapitalizations. Structural AD adjusts the conversion price on the preferred stock to ensure that the preferred shareholders receive the appropriate number of common shares upon conversion, such that their original percentage of ownership is maintained. Suppose, in our example, that our $10 million investment was originally sold to investors in the round for $5 per share. On an if-converted basis, investors would be entitled to 2 million common shares. If the company decides to have a 2-for-1 stock split of its outstanding common shares, the conversion price is reduced in half to $2.50, or $5 divided by 2. And investors would now convert into 4 million common shares, so that their shares times the new conversion price will still equal $10 million. This is an example of the most basic form of structural anti-dilution. Another form of non-price-based anti-dilution is the right of first refusal, also called a preemptive right or a right to participate. This provision gives the preferred shareholders the right to participate in future funding rounds ahead of other investors. It typically allows them to purchase up to their pro rata share in the next round, meaning if they held 40% of the Series A round, they are entitled to buy up to 40% of a Series B round. These provisions are particularly important in preserving the investor's ownership percentage against dilution in an up round of financing, or the circumstances where the Series B round's price exceeds the Series A round's price. These 2 terms are universally included in term sheets and may be qualified in different ways. However, the absence of them would be a serious omission as far as investors are concerned. Price-based anti-dilution differs from non-price-based anti-dilution because it is triggered by reductions in the price of shares sold to investors in subsequent rounds. This is why it is called price-based anti-dilution. The valuation of early-stage companies is uncertain, and investors could be investing in a company whose value adjusts downward before it stabilizes and resumes positive growth in value. For this reason, investors seek price protection, that is, protection from the dilutive effects of a later round that is priced below the price at which they bought into the company. There are 2 common forms of price-based anti-dilution: full ratchet AD and weighted average anti-dilution. Full ratchet protection is generally considered a severe form of anti-dilution protection because it forces the common shareholders to absorb most of the dilution. It lowers the conversion price on the original round to the next round's price. Weighted average anti-dilution is a more frequently encountered form of anti-dilution protection in early-stage deals and is generally more favorable to the entrepreneur. Weighted average anti-dilution adjusts the conversion price by considering both the amount and price of the diluted round of financing in relation to the value of the company in the prior round. It lowers the conversion price on the original round to a price between the prices on the prior and subsequent round of financing. Let's consider the effects of anti-dilution by way of an example. In order for anti-dilution to take effect, there must be another round of funding after the Series A round. Returning to our earlier example, we assume that the Series A investors or first-round investors provided $10 million in funding at $5 per share and received as a result of this the equivalent of 2 million shares. Prior to the Series A round, there were 3 million common shares held by the founders. Based on these values, the Series A investors held 40% of the equity following the completion of the Series A round, or 2 million out of the total 5 million post-Series A shares outstanding. Now assume sometime later, Ultratech has nearly run out of money and is in the process of raising a B or second round. However, things have not gone according to plan, and the company has missed several milestones. As a result of this, it is only able to raise a Series B round of $5 million at a price of $3.50 per share. A subsequent round of financing that occurs at a lower price than the prior round is termed a down round, and this event triggers price-based anti-dilution. The Series A investors will now be able to adjust their original terms in light of the unfavorable valuation of the second round. In effect, this gives the Series A investors the right to a do-over in the face of the declining value. If the terms of the term sheet granted the Series A investors full ratchet anti-dilution, their original investment of $10 million would be repriced. That is converted into common at the Series B round price of $3.50 per share. In effect, the adjustment in the conversion price allows the Series A investors to pay the same price for their shares as the Series B investors. This adjustment increases the number of shares that Series A holds to 2.9 million shares from their original 2 million shares. Importantly, this price adjustment occurs regardless of how many shares are issued or the amount of money raised in the Series B round. Thus, a company seeking to issue even a small number of shares in order to raise needed capital is forced to adjust the share ownership of all the preferred shareholders who hold this right in the previous rounds. Now let's consider the alternative weighted average anti-dilution. Rather than the new conversion price equaling the round B price, the conversion price will be between the original Series A price $5 and $3.50 per share, the Series B round price. Where in that range the price falls depends on the relationship between the value of the company before the Series B round, which I call old money, and the amount of money raised in the Series B round, or new money. Weighted average anti-dilution is thought to be more fair because it's the blended price that results from the relative contributions of the prior money and the new money to the value of the company. To calculate the new conversion price, we must first find the value of the company before the Series B round takes place. In essence, this is the post-money value following completion of Series A. In total, there were 5 million shares outstanding after the completion of the Series A round, times $5 per share. Thus, the value of old money, or the post-money value following Series A, is $25 million. The amount raised in Series B is $5 million, so that the total value of the company prior to the adjustment for anti-dilution is $30 million. This total is divided by the total number of shares outstanding before adjusting for anti-dilution, or 6.4 million shares. The sum of the 5 million shares through the Series A round and the additional 1.4 million shares to be issued in round B. Dividing 30 million by 6.4 million shares gives a new conversion price under weighted average anti-dilution of $4.70 per share. Because the conversion price is higher under weighted average than full ratchet, the Series A investors will receive fewer shares, 2.1 million, after adjusting for anti-dilution. The 2.1 million shares is found by dividing the original $10 million investment by the new conversion price of $4.70 per share. Notice here that because the new money raised in the round B is relatively small, $5 million, in relation to the value of old money, or $25 million, the conversion price under weighted average is not much lower than the original $5 per share. Thus, the small increase in Series A shares to 2.1 million is the result of a relatively small amount of small adjustment for anti-dilution. Note that under either form of anti-dilution, no capital is returned to the investor. Rather, the Series A investors simply receive more shares. The goal of anti-dilution is to protect the Series A ownership stakes from dilution as future funding rounds occur. So let's look at how successful anti-dilution has been in protecting the equity stake of Series A after Series B is completed. In this case, we assume that Series A will not exercise its right of first refusal and therefore not purchase additional shares in the Series B round. To calculate the adjusted equity stakes, we must recompute the total shares outstanding, taking into account the new shares awarded to Series A under anti-dilution. Under full ratchet, the new total shares outstanding is the sum of the 3 million shares before Series A, plus the 1.4 million new shares issued to Series B, and the 2.9 million shares for Series A after the adjustment for full ratchet anti-dilution, for a total of 7.3 million shares. As a result, Series A owns 39% of the equity, which is 2.9 million shares of the 7.3 million total shares outstanding after the completion of Series B. Series A originally held 40% of the equity, so even under full ratchet, their original equity stake is slightly diluted. As might be expected, Series A suffers greater dilution under weighted average anti-dilution because they do not receive as many additional shares. In this case, their share ownership drops to 33% after completion of the down round. Sometimes students intuitively think that full ratchet will preserve Series A original 40% equity stake. I purposely constructed this example to show that this is not always the case. What is always maintained under full ratchet is the original liquidation preference of Series A, or $10 million. We know from earlier in the lesson that the liquidation preference is their entitlement to exit proceeds, and this has not been diminished by the down round in Series B. In this case, we see that the Series A investors still maintain a $10 million liquidation preference. The same cannot be said of weighted average anti-dilution. In this case, the Series A liquidation preference is reduced to $7.5 million, and we can see why full ratchet is a more investor-friendly term. Up to this point, we haven't said anything about how the common shareholders or founders have fared under a down round financing. All investors should be concerned about the equity stake of the founders and whether, after consecutive financing rounds, they retain enough incentive to drive the growth and development of the firm. If all of the original 3 million shares were held by the founders, after completion of the Series B round, their ownership is reduced to 41% under full ratchet and to 46% under weighted average anti-dilution. The founders held 60% of the equity after the Series A round, and this shows they suffer significantly more dilution from the down round than the preferred shareholders. Because of the term sheet's protective rights, the common shareholders bear the brunt of dilution. In this instance, the dilution would be even greater were it not for the fact that the Series B round of financing of $5 million is small and only half the amount of Series A. Price-based anti-dilution protection is sometimes subject to a pay-to-play provision, which means that the preferred shareholders have to participate in the next round of funding and purchase their pro rata share in order to have their protective provisions carry into the next round. If the term sheet includes this term, then the Series A investors have to provide new funds and participate in the next round, or they don't get to keep their earlier negotiated terms. A pay-to-play provision is generally more favorable to the entrepreneur because it requires the Series A investors to provide funding in the next round in order to keep their protective provisions. The table summarizes the range of possibilities for the anti-dilution term as it may be negotiated to afford greater or lesser benefits to the parties involved. We next discuss two other features of the term sheet that are important in determining the future course or control of the firm: redemption and control rights. Redemption gives investors the right to force the company to redeem or buy back the investor stake at a specified time in the future. The principal reason investors include this term is because it provides them with a known liquidity event in the case the investment begins to perform poorly and an exit becomes unlikely. Redemption can be thought of as a put option that investors hold to sell the company back to the entrepreneurs. The redemption price is usually either the fair market value of the stock, as determined by a mutually agreed upon appraiser, or the original price of the stock, or some multiple thereof plus unpaid dividends. Entrepreneurs often feel threatened by this term because the company may still be trying to stabilize its operations and find itself approaching a redemption deadline without the necessary cash to both redeem the preferred stock and continue operations. Further, redemption rights may serve to block future financings, as potential investors fear that their funds might simply be used to pay for the redemption. In short, it can be a sword that hangs over the firm. Investors, on the other hand, are clearly advantaged if they are able to negotiate a right of redemption. Even in the most likely case where the company doesn't have enough money to redeem them, it still gives them bargaining power over the entrepreneur. And investors may choose to waive this provision if they can get entrepreneurs to make other concessions. When a redemption right is granted, the right is usually constrained in some way, such as making the right exercisable only after some period of time, for example 6 or 7 years, or conditioning the redemption on the approval of a certain percentage of the preferred shareholders, say 80%. A further condition might allow the redemption payment to be spread over 2 or 3 years in order to soften the blow on the company's cash flows. The table summarizes the forms of redemption and the way they can be worded to be more favorable to the entrepreneur or investor. The last feature of the term sheet we consider concerns control rights. Control rights allow the investor to exercise overt control over key company decisions, which provides them with critical influence over the company's direction and future development. Control rights can be obtained in two ways: through board representation or through voting controls over certain actions, referred to as protective provisions. The most obvious way for the preferred shareholders to exercise control is to have the right to designate members of the board of directors. The board oversees the company's business and appoints officers to carry out daily operations. Shareholders elect directors, generally by a voting scheme of one share, one vote. However, the term sheet can allow certain shareholders to elect a designated number of directors. Therefore, board control does not necessarily follow equity ownership percentages. Investors can also negotiate a variety of types of board involvement, ranging from outright control, a seat on the board, or simply observation rights. Observation rights permit an investor representative to attend board meetings, but do not grant voting rights to them. Further, investor rights can be structured so that, as the company progresses and meets certain milestones, the number of investor representatives on the board decreases. Conversely, the right can be structured so that if the company fails to meet milestones or otherwise breaches contract terms, the preferred shareholders may acquire the right to elect a majority of the board. The range of provisions for board representation are summarized in the table. Protective provisions require a vote by the preferred shareholders before the company can take certain actions. Actions that are subject to a vote generally include any changes to rights specifically designed to protect an investor's interest. For example, those relating to the payment of dividends, liquidation, conversion, redemption, dilution, voting, the issuance of additional shares, and the structure of the board of directors. Investors will also want some control over any action in which they risk a loss of control, such as the sale of certain assets, mergers, and other types of consolidations or major changes in ownership. Generally speaking, the greater the number of protective provisions listed in the term sheet, the so-called length of the list, the more influence investors have over the company. The approval threshold for such a vote may range from a simple majority, which is preferred by the entrepreneurs to facilitate certain actions such as future financings, to a supermajority, which is preferred by investors in order to retain a high level of control over such actions. Often these voting controls are subject to a percentage floor. In other words, if the number of outstanding shares of preferred stock drops below a certain threshold, say 25%, the investor's voting controls would be extinguished. The table summarizes some of the potential ways that protective provisions can be structured. This note has outlined the effect of key terms of an early-stage term sheet on the parties involved in the deal. Whether the terms for a particular deal turn out to be investor-friendly, in the middle, or entrepreneur-friendly depends in large part on the market conditions and the strength of the two parties' bargaining powers. Factors that can influence each party's relative bargaining power include how critically the funds are needed, how well the company is performing, how many other potential investors are interested in the company, the number of similar investments available, and a particular investor's risk and return goals. It is important to use bargaining power wisely and focus on those terms that have the greatest capacity to make a material difference in the returns and outcomes for the parties. The old adage about choosing one's battles carefully is a good guide in negotiating the terms of an early-stage investment. After completing this lesson, you should now have a better sense of which terms to focus on and why.